All right. Hi, and welcome everyone to another exciting session at the Digital Container Summit. My name is Alexa. I'm the marketing manager here at Container Exchange, and I'm super happy to present the session of Lars Jensen, the founder of Sea Intelligence Consulting. And he's going to tell us about how disruptive the pandemic is to container shipping and which changes will remain permanent. But before, a little bit about Lars. He has nearly 2 decades of experience in the container shipping industry. This comprises an extensive career in driving and developing marketing intelligence and analysis, as well as e-commerce strategy for Maersk. And since 2011, Lars Jensen has acted as an independent strategic analyst, thought leader, celebrity. You've definitely seen him on LinkedIn. You've definitely seen his post there, guarantee it. Everybody knows his name in the industry, and I'm super happy to give it to him now to tell us about the pandemic. Over to you, Lars.
Thanks, Alexa, and thanks for inviting me to come on here today. So, given that we only have half an hour, including questions, and yes, there will be time for questions towards the end, let me just jump into it real quick in terms of how disruptive the pandemic is and what changes are likely to become permanent. Now, just setting the stage, if we were talking here back in January, this is all we would be talking about. Well, actually, this is all everybody was talking about. That was how disruptive the low sulfur changeover was going to be, how potentially loss-making the carriers would be because of the low sulfur rules. That was the big topic for 2020. This turned out to be an absolute non-issue. Not only were we completely superseded by the pandemic, but all the expectations of oil prices were going completely out the window. The expectation was a premium of $200 a ton. That is now $50. The actual low sulfur fuel prices now are below where the fuel prices for heavy fuel were last year. So what was supposed to be the largest financial challenge for 2020 has turned out to be not only a non-issue, but actually an aspect that helps profitability of carriers because they're now saving on fuel prices. If we start out on the global demand side, first thing to keep in mind is global demand growth was actually slowing down during 2019. And just before the pandemic hit, we were actually at a point where we were more or less at 0% growth in round numbers. As you can see here, the bulk of the pandemic impact was March, April, May, where in April, global container demand declined almost 15%. But it's also worthwhile noting that the latest numbers, which are from June 2020, shows global demand down only 5%. The July numbers from Container Trade Statistics are likely to be out on Monday here in the coming week. And my expectation is that that will also be somewhere between 0 and -5. Let's see how that pans out. But it does mean, and I'm going to address this slightly more later on as well, that we are in a situation where despite the huge economic impact of the pandemic, it appears the container shipping industry is already over the worst in terms of demand impact. But of course, and as all participants in the market know full well, when we were at peak impact, what the container carriers did real quick was remove capacity. This is one of the signs of a change that is permanent going forward to some degree. In the past, whenever demand declined, the knee-jerk reaction of the industry was to dump prices, to try to fill their remaining ships. Nobody wanted to be the first to remove capacity. This time around, it was completely different. All the carriers, with basically no exception, were pulling capacity within a week of it being clear where the pandemic was impacting. It was slightly different how much they pulled and where they pulled it, but basically, it turned out it absolutely worked. If we just take this from a starting point, the most, you can say, benign impact, for want of a better word, is on the main Asia-North Europe service. We have seen a gradual increase in freight rates, but not necessarily a spiking of rates here towards the second half of 2020. Carriers have been real good at capacity management. Asia-US West Coast is a very different story, as we can see. that was a fairly level rate development we had most of last year. But as we are then approaching summer, we see first one round of massive price spikes that brought us up to almost $3,000 per FFE. This was clearly a result of carriers pulling capacity and likely pulling a little bit too much capacity. A very brief period of relatively stable rates, and as we are speaking, they are skyrocketing once more, and we are now at freight rate levels. It is always dangerous to say historically high, because that always depends on how far back you go. But in terms of spot rates, the longest index we have is the SCFI, goes back 11 years. And on that count, it definitely is historically high. Now, the second spike in rates we are seeing now is actually not driven by capacity being pulled out. Reality on the Trans-Pacific right now is we have more capacity than we had last year. We're about 10% up on capacity. So this second wave is being driven by an extraordinary high level of demand going into the US despite the economic malaise. Asia, East Coast, South America is also worth noting, because unlike the main East-West trades, freight rates on Asia, East Coast, South America actually plummeted as a consequence of the pandemic. We went from more than $2,000 per container down to $500. So we were down about 80% at the peak of the pandemic. And it's worthwhile noting why this is, because on Asia, North Europe, and also on the Trans-Pacific, these are trades that are not only highly concentrated, but more importantly, have a large number of weekly services. If I operate as an alliance 10 weekly services, that basically means I can adjust my capacity in steps of 10%. I can cancel one service. On Asia, East Coast, South America, there are only 4 services directly in the entire market. And they are basically split in roughly 2 groups, which means that anyone who wanted to remove capacity from Asia to East Coast, South America could only adjust that in steps of 50%, which tends to lead to a path where you don't want to be the first one to remove capacity. So in Asia, East Coast, South America, we saw the what you can call usual pattern of waiting to pull capacity with catastrophic impact on rates. It's only very recently that we have seen a pullback on that one. And this actually is a harbinger of where we also see the markets going in the medium to long-term future. Because pulling capacity was actually not new. It was something the carriers had already been, let's say, practicing over the last couple of years. We have seen a gradual increase in blank sailings, and now it's been proven beyond a shadow of a doubt just how effective this is. It is exceedingly likely that carriers will continue to exhibit strong capacity management going forward, which also means on the longer phase, the transition everybody should expect here is basically, to lay it out in simple terms, in the past, the normal state of affairs was a more or less overt price war interspersed with brief periods where rates would go up. Going forward, it's going to be the other way around. The base going forward is strong capacity management and fairly high and stable rates, and then interspersed with brief periods of price wars when it falters. So we're going to see a shift in balance here. Also, if we're looking at some of the disruptive effects the pandemic has had, well, we had the sharp demand decline. We already covered that. But this also led to a significant degree of disruption in equipment imbalances, because demand did not drop the same on all trade lanes. And particularly if we look at South America, dry cargo, we've actually had at the peak of the pandemic a reversal of trade balances, where normally there are more dry containers imported into South America than is being exported. This actually reversed during the height of the pandemic. And for carriers, this creates a huge problem with how do you manage your equipment flows. And depending on where you are, this can actually have a significant impact on the backhaul, especially if you look at Europe going back to Asia, which is a traditional backhaul. Freight rates there for exporters have more than doubled, and they're still staying at those levels. This is one of the consequences of the imbalance disruption. Secondly, we had the idling of vessels and massive blank sailings. We also covered exactly how effectful that was, but also that this is likely to continue going forward. Another clear disruptive effect that we have seen is, well, not surprisingly, people were not able to go to work, so we have to work from home. And that has served to highlight where do we have manual workflow processes that are dependent on people being in the office. We have been talking, and we will a little bit later here today, for years about the digital changes in shipping. What the pandemic serves to do here is to make it abundantly clear where do we still have manual process gaps that has not been digitized. And what's going to happen in the coming years is we're going to see a sharp focus on accelerating the digitalization of precisely these stopgaps, because now it's clear where they are. Another practical issue more from the shipping lines is crew change became almost impossible. This led to the unfortunate situation of crew that quite literally for months could not go home, but instead basically had no choice but to stay at work and move the ships. This is a huge problem, not just for container shipping, but for the entire shipping industry. Now, last time we saw all these massive disruptions was actually during the financial crisis a bit over a decade ago. And at that point in time, the container carriers suffered catastrophic losses. So going into the pandemic, and when the pandemic was basically raging, the natural assumption would be that when we are in a situation of a demand decline that is on par with what we saw in the financial crisis, then surely the carriers were also going to be heavily loss-making this year. Now, it's not many weeks ago I updated my model for what's going to happen with carrier profitability. And this is basically where we are right now. Now, first of all, these are the combined profits for all the large carriers together at the EBIT level. And it also includes high-level estimates for MSC. As some of you might know, MSC is the second largest carrier, but they do not disclose any financials at all. So the way to make a reasonable estimation for the industry is simply to assume MSC is on par with the average of their main competitors. Now, last year, the industry as a whole had a profit just shy of $6 billion. If we're looking at full year 2020 and made the assumption that we would have freight rates at the same level as last year, the carriers would still be profitable now at a level of around $4 billion. But that's not the case. If we look at year to date, what freight rates have actually done, we are actually on track for the industry to have a profit of around $13 billion. Furthermore, we can also estimate it a different way. Most of the carriers have now announced their first half results for 2020. If we use that as an indicator, then they're actually on track for a $15 billion profit. So what we're looking at here is an industry based on what we've seen so far that is going to more than double their profits compared to last year in the midst of the pandemic. Of course, Q4 is still the big unknown. So what if rates fall back in Q4 to the levels we saw last year? Well, we would still have more than $10 billion of profits. What if the carriers enter into a vicious price war in Q4 and rates completely collapse? In that case, we would still be profitable, but at a somewhat lower level at $4 billion. What if volumes were also to drop in Q4 by 5% rather than the stabilization we're looking at? We are still looking at a $9 billion profit. And what if volumes decline and we have a freight rate war? We are still profitable at about half the level of what we had last year. So what we are looking at here as an impact of the pandemic is very counterintuitive. The pandemic has had severe operational repercussions, but it has also had the result that carriers are going to be more profitable, vastly more profitable than what they were last year. Now, that sounds on the face of it completely illogical. And if you're looking for a single explanation as to why that is, you are likely going to fail. It's more of a confluence of different events all coming together at the same time. These are actually not new developments. These different developments have been underway at a slow pace for the last couple of years. They have simply been accelerated by the pandemic all at the same time. One of them is consolidation. In order for the carriers to be successful in managing capacity, it requires a relatively high level of consolidation in the industry. This is something that has been ongoing for the last 20 years, and it has not happened overnight. We are now at a point where, depending on how you count it, you have 7, 8, 9 global carriers that basically control most of the global container shipping markets. Once you go beyond those global carriers, you're down into niche carriers in specific niche markets. And is that a harbinger to come in the still fragmented parts? To some degree, yes, because this works phenomenally well on the main deep sea trades. You still have very fragmented markets on intra-Asia, on intra-Europe, on intra-Americas. What is very likely to unfold over the coming 5 years is also another consolidation round, this time amongst the intra-regional carriers. It's an open question to which degree the main global carriers will actively play a part in that, or whether they're going to see the emergence of true large consolidated players in the intra-regional markets, but the consolidation here will indeed be coming. This, of course, has a range of implications for other players in the market. One of them is for ports and terminals. Ports and terminals have to get used to a market where there will be an increased active usage of blank sailings. That is simply the new norm. They are going to face a market where carriers are going to be more flexible on their transshipment patterns. They will be able to more quickly shift volumes around. And also where the short-term and inventory impact on demand is substantial. This large growth in container volumes, especially on the Trans-Pacific right now, is to a significant degree very likely driven by an inventory impact, which means the effect here is going to be temporary, and therefore we're going to see a high degree of volume volatility. A second aspect is the digital development. And what we are seeing unfolding right now is the hundreds of different maritime digital companies that have been trying to get into the industry over the last 5 years. They are right now being battle tested, for want of a better word. It is becoming extremely clear right now which ones of all these tools / companies are actually providing value and are helping in this situation. Do they bring value? They are accelerating rapidly right now. Which ones do not have a product that actually gets used? They are likely to fall by the wayside within the next 12 months because they did not prove their worth when they were really in a situation where this is all about digital. And just to put a number on the uptick, let's look at online shipping, where you basically go in, you get a price, you book, and you get your freight moved. Seen from the perspective of the container lines, this number was basically 0 2 years ago. As per the Q2 results that came out, Maersk is now at a point where 41% of their spot bookings, not their total bookings, but their spot bookings, are now done online, up from about 0 2 years ago. I then went to Hapag-Lloyd to get their updated numbers, and they confirmed also they are now at a run rate of around 11% of their total volumes, again up from 0 a couple of years ago, which translates into somewhere between half and a third of their spot bookings. We are now seeing a number of other carriers rapidly following suit, like Evergreen, MSC, Zim, coming up with similar online tools. This is a development that is going to accelerate very, very quickly. And this is not because it's a new development. It was already in the pipeline, but the pandemic serves to make this happen a lot faster. Then we're seeing major shifts in consumption patterns. Think back to January. Lots of people were spending their hard-earned money going to physical supermarkets or going to bars, going to restaurants. That has changed dramatically, and this has a severe impact on container shipping. If we take the bars, restaurants, travels, well, when the world halfway shut down, bars closed in many places, that leaves surplus cash with the consumers. And it seems clear that some of that cash has been transferred into the procurement of physical goods, which then move in containers. That is why we can now see the counterintuitive development that despite the economic crisis, we are seeing people buy more physical goods, simply because of a major reallocation in how you spend your money on services versus physical goods. Secondly, When you're no longer going to the physical stores, or at least to a smaller degree going to the physical stores, and you're buying online, that also has an impact. Because when I buy online, my expectation obviously is I'm going to have delivery tomorrow, or not that I'm going to be told it will be 6 weeks on sea. So there's a lot of retailers that need to fill up their inventories for the goods that people are buying online, and chances are the stuff that's being bought online does not quite match what people were buying 6 months ago. So it was not the right items that were in the warehouses as the pandemic started. So this all serves to sharply accelerate demand growth right now. But it also means that both of these effects are likely to be reversed at some point. Now, you will not see necessarily the reversal of people starting to go back to the stores. There might be a permanent shift here, but it means that the rush to fill up the inventories will reach its natural saturation point, and then demand growth will come down somewhat as we now just need to maintain inventory levels. Once you see bars, nightclubs, restaurants, travel come back online, it's likely going to be a more slow and gradual process over the next couple of years, but that will tend to siphon away some of the consumption right now being spent on physical goods, and you will see a dampener again come on to demand. So the spikes we are seeing in the demand now should be seen as temporary and not permanent. So basically, most of the industry right now is focused on how can we automate, how can we get all the digital tools to work. But what we are missing to see is how are they going to handle exceptions, because there are and always will be massive amounts of exceptions in the supply chain. This is where the actual competitive advantage exists. The automation will continue to drive the industry towards an ever higher level of commoditization, which will put their profitability under pressure. It's the exception handling that's going to be important, and this is where we're only in the beginning phases. And importantly, if you look at this from a container liner perspective, this is going to lead to fewer employees. As we are automating more and more processes, there will be need for a lot less people on the back end. The people that are then going to be left on board are people that need a very different skill set. In simplistic terms, think about it this way. If you today spend 90% of your time doing customer service processes when things go according to plan and 10% handling the exceptions, going forward, ideally, you're going to spend 100% of your time purely on the exceptions. So the remaining employees need a very different skill set going forward. And to round this off, I want to highlight 3 additional issues that are going to be immensely important for the next, I would even say, 5 to 10 years. And it's going to shape the frame of everything that will happen. The first one is carbon neutral shipping. This was already beginning to make headlines in the industry before the pandemic. It's going to be increasingly important. If you look at the IMO carbon targets for 2030 and 2050, there is no way the industry can meet those targets by making incremental changes in what they do, and the industry has also realized this. That means we're going to have to see dramatic changes in what types of vessels are we going to order, what type of propulsion, what will even be the cost. There's a large element of unknowns here, but this is going to have a significant impact going forward. One of the aspects that, for example, is completely unknown right now is to which degree will the industry be subjected to a carbon tax. It appears increasingly likely that a carbon tax will be introduced within the not too distant future. It is right now completely unclear how that will be implemented, but it will carry with it a cost, and that cost ultimately will find its way through the supply chain. Government interference has always been clear in the industry, but it also appears that government interference might potentially grow slightly stronger going forward. There are clearly governments around the world who see shipping in general, and therefore also container shipping, as a national strategic interest. They are increasingly willing to provide either overt or covert subsidies. That can either be subsidies in terms of outright funds, it can be better loan conditions, it can be trade conditions, cabotage rules. It is likely that we're entering into a period where government interference becomes stronger not weaker, and that will put pressure on carriers that are more operated on market conditions and less supported by the governments. And that brings us to the last item that's also going to be important: trade wars. If you have been following some of the reports that are coming out on trade over the last 5 years, you will have seen that we are in a phase where there is an increasing number of trade barriers that have been put up. And this was even before the US-China trade war came up. So we appear to be heading into a period that is slightly more protectionistic, where we do have more trade wars. From a container shipping perspective, this is not necessarily all bad. The bad news is obviously when trade wars lead to economic downturn, less goods being moved. However, there's also an aspect here that is an opportunity for some shipping companies and ports, because let's take the US-China trade war as an example. There are many commodities where the US imports from China declined, but the overall US imports did actually not decline. The only thing that happened was these goods are now shipped from Vietnam or Indonesia, the Philippines, Thailand, Cambodia, and at the end of the day, they still make it onto a trans-Pacific vessel. But what it does mean is an opportunity for other ports, for other countries, and you see an uptick in more usage of feeder services because trade tends to be more dispersed rather than go between a few individual large port pairs. So with that, let me try to, I was about to say sum it up in a word. That would not be completely right. But where we are in the industry is, yes, it has been disruptive, but the carriers have completely changed the way they are operating their businesses. They have been able to navigate very solidly through the crisis, and it is a skill they are likely to continue to wield going forward. We are facing a market where the level of pricing power has increased for the carriers, and that is a permanent change. That is going to happen. Will we still sometimes see them engage into a price war? Sure, but that's not going to be the permanent state of affairs going forward. So with that, let me head it back to you, Alexa, and see if there are any questions. Alexa? I am not sure if you can hear me. At least I cannot hear you.
Lars, can you hear me?
Yes, there you are.
Super. All right. Yeah, I think we have time for a few questions. We have one that just came in. David Cook is asking, the digital potential has been with us, considering Maersk, for example, for 10 to 15 years. Why has it all been so slow, being an industry standard? Is COVID-19 the motivating factor?
To some degree, it's the motivating factor. I mean, if you look over, I would even say the last 15, 20 years, the potential has been there. There are a number of reasons why it failed to take up. The carriers were not necessarily willing to change their internal processes, but also I've often seen that customers were not necessarily willing to change their ways on how they engage. So it's a level of, you can say, let's call it a maturity process, where there was a large digital push 2005 to 2010 that really went nowhere because none of the parties on either side were truly motivated to make the changes. This was slowly beginning to happen the last couple of years, but the pandemic has clearly put the pedal to the metal in terms of this one. It accelerated extremely sharply now that everyone suddenly had to work from home.
Mm-hmm. Makes sense. So again, in that digital, we've got some more questions about digitization. So when COVID-19 is behind us, do you think that the digitization progress will come to a halt again, or will it continue to grow?
It will certainly continue to grow, because you can say it's all more or less a self-fulfilling prophecy. Once you've shifted over to digital, your competitors are going to be forced to come through. Let's make a very simple hypothetical example. Before this, if I wanted to get a freight quote, I might call around to, say, 4 or 5 different providers. That could be carriers, it could be logistics providers, to get a quote. Now suddenly one carrier can actually allow me to see it online. That's a lot easier. I'll just look at that one, and then I'm only going to call 3. 2 carriers make it available. Now I'm only going to call 2. The moment I'm at 4, well, if I'm not online, my phone will stop ringing. I'll get zero business. So this is going to be an accelerating process.
All right, good. Okay, so we've got to wrap it up here. The next session starts in less than a minute. So thank you, everyone, and thank you so much, Lars. We really appreciate
Thanks for having me.
Yeah, and have a great Digital Container Summit, everyone.